Welcome and good evening, everybody, and to tonight's webinar, Techniques to Improve Your Strategy, um, provided by LegacyFX. My name is Mike Rotting. Before we get into everything, obviously, take a minute to read the risk disclaimer. Yeah, it should be long enough. All right. So what we're going to discuss, well, firstly, I'll introduce myself a little bit so you have a little bit of an idea of who I am and what do I do. Then we're going to discuss three different topics actually today. So we're going to look firstly at grid trading. I'm going to brush over that for those that want to know about this technique. Then we're going to talk about Fibonacci, Fibonacci retracements, basically how you would implement those, how you could incorporate those into your general trading strategy. And the last one that I'll discuss is Elliott Wave principle. Now, this is a four-parter. It is a little bit more complicated. And I'll say it up front, it's probably not for beginners, but okay. And in the end, for those that are of you that are in the actual live webinar, there will be Q&A after all of this where you guys take the floor and just fire away, right? That won't be in the YouTube part if you're watching the video. Okay. So about me. So who am I? Well, like I said, I'm Mike Rotting. I live in Athens in Greece. I've been trading for a little over 15 years. It started when I was in college in the Netherlands, doing international business studies, Cambridge program there. And like most, the first, one or two accounts, didn't quite work out all that well. Generally speaking, I was watching, get rich fast kind of trading things like, every young one, I want to get rich fast kind of thing. Quickly to realize, obviously, this doesn't work. This is not really how the market works. It doesn't mean it doesn't happen, but generally speaking, it's not the rule of thumb, it's the exception. So after all that, eventually I rolled into basically fast forwarding 15 years, having a consistently profitable account, and kind of allowed me to rotate out of retail trading a bit more and more to diversify myself into offshore investments and portfolio things that I can just offhand. But obviously, I keep in touch with my normal trading. So that brings me to what do I do? For the last 6 years now, I have been doing webinars like this. It's kind of my attempt to, well, obviously for the companies that hire me to provide, some content for you guys. But from my end, it's hoping to pass on some of the knowledge that worked for me and trying to make it comprehensible for others that hopefully to avoid some of the beginner mistakes. And in some cases, like tonight, like a little bit more the complicated, like more advanced things that you might have not picked up yet and you could incorporate into your strategies and then, have some starting block to work with. Apart from that, obviously do mentoring, and I am working on my CSI level 1, which is a financial advisory kind of certificate, first stage. This is just for myself to have a little bit more knowledge on, the offshore investment markets and the backgrounds and everything else. And obviously, I'm kind of like invited to 2 other projects that usually investment or financially related, right? Fund runs and stuff like that. So that's me in a nutshell. Okay, so considering we have quite a bit, so we'll get right into it. So grid trading, in essence, right? And everything we're going to do after every single topic, we're going to go to a chart and I'll show you, right? So it's not going to be just slides for you guys. So grid trading basically focuses more on fundamental movements in the market, but you divide that into a grid. So what this does is basically allow you to kind of negate, and this is kind of a technique generally used by people that don't believe in technical drawings that much, but more in the fundamental status of a market, right? So if you look at any security that you can trade, there is a pattern on the which way it's growing or the way that it's moving. Like for the years, for instance, Euro CHF of US dollar CHF has been kind of moving sideways, right? So all these kind of things come into the idea of how to trade based on a grid that you make, right? So the fundamental part is it generally grows by X% per year or declines by X% a year. And based on that, I just trade every single little thing along the way. To do that, there's different techniques in that, and we'll get back to that in a minute. Now, one thing to note is that you do need to be selective on your grid spacing, and this will become more clear when we talk about the pros and cons in 1 second. Because you're the one drawing the grid, so you divide the chart up in grids of your choosing, and I'm going to show that in a minute where we can make different types of grids. The idea behind it is that every grid line is an entry and exit point. So you trade literally from line to line to line to line to line. Now, this obviously has some pros and cons. So one of the pros is that if you use this technique, you generally end up with a very high win rate. And you will see this a lot in, for instance, social trading platforms where you will get this, right? Well, people have like an 80 or 90% win rate. But there is a catch to why that's a high win rate. Well, first of all, let's finish the pros. So with the other thing is that the entry point, because of this technique, entry points are not that important, right? It's more of just going into the market than rather timing when you go into the market. With other techniques, you try to determine when the consolidation phase has started and maybe cross-reference that with price action in accordance with maybe Fibonacci retracement or something like that, which we'll get to later, in order to look at fundamental basis, price levels, supply-demand zones, as complicated as you may be at. And then you judge your entry point based off that, and then you make an extrapolation based on past data in order to judge where your possible exit points could be based on support and resistance levels, et cetera, et cetera. This technique kind of ignores all of that because you basically just divide up the map, like I said, or the chart into different grids, and every single grid line is basically an entry and exit point, which makes it an extremely simple strategy. And I would go with the word simplistic. Generally speaking, in trading, although it's not rocket science, it's generally not simplistic. Okay, trading can be as complicated as you want it to be and as simple as you want to be. If you boil down the essence of trading, it comes down to buy on lows, sell on highs, and the other way around, right? That concept has always been the same. The problem is that it is a suggestive market, meaning that the market, although all these techniques that we're going to discuss today have like a reoccurrent theme, nothing is written in stone. It can do anything else at any given time if it so feel like it. If the market makers make it do that, or there's a significant change in the market that makes it do that, right? Now, one of the big cons when using basically grid trading, and that is in most techniques, there are exceptions. There's more than the three techniques that I'm going to show you, but generally speaking, grid trading does not utilize a stop loss. And this is, for most traders, just bad. Now, it doesn't necessarily mean no stop loss is bad. Swing trading generally doesn't have a stop loss. Your capital is kind of your stop loss, which is also what makes it risky. But that points to a second con. Basically, there's a risk of you blowing up your account. You need to understand that even if you have, let's say, a $10,000 account, and I'll show you this, especially with things like a Martingale grid trading strategy, where you need a lot of capital because you're pre-building up and you're trading a grid. So you always have moving capital. So that eats into your margin. So generally speaking, this is also a very terrible system to utilize. And this will become more apparent when I show you on the chart in a minute. It's a very terrible system to utilize if you have a small account, which means $5,000 to $2,000 or $500 to $2,000. That's just like it really eats away in your capital and really becomes hard to maintain a steady input of trade. Now, there's a technique that kind of counters that, which is one that I'll cover today. But because you don't have a stop loss, which again is a suggestive point. Some say it's bad, some say it's good. I mean, I always trade with stop loss, but other traders will trade like swing traders generally don't. When you have the risk of blowing up your account, and like I said, because you're scaling into the market, because as the grids continue, you keep adding trades, and you don't close them until you reach profit points. So you're basically building up, which means that you need more capital because you're scaling into the market. That's the concept, right? You're building up different trades. So let's say you have 10 different entry points, then the average entry price is the fifth one because you have 4 less and 4 more. So when the price then the market then turns and it turns back, eventually and it goes back down, then you make profit on all of them, being the last one being the most profitable, obviously, in the down run, until you decide to cash out. And this is very, very important to understand that you're scaling into the market, so you need capital to do that. And I'll show you that. That becomes really, really apparent once I explain to you the next steps. And then we'll show you on a chart. So version 1. So this is a buy and sell strategy, as they call it, which means that each trade is a buy and sell of the same lot size at the same time. So every grid line, you open a buy and a sell at the same time. In other words, you're preemptively hedging your own trade. Benefit? Doesn't matter which way the market goes, you will have a winning trade. Right? But that also means you have an equal and correlating down trade. We'll get back to how that works later. So every new grid is an exit for the winning trade and the opening of 2 new positions and then leaving the losing trade open. Right? So in an example, let's say this is the market trade, right? So this is the grids, right? The first trade, we open a buy and a sell, whatever, 1 mini lot, and this is 100 pips, which doesn't really matter. I open 1 mini lot, buy and a sell. So basically I'm not doing anything. The market decides to go up and it hits my second grid line. What I do is I cash in my buy, I open another buy, again, 1 mini lot, and I open another sell, again, 1 mini lot. So now I have a losing sell, a neutral buy, 1 profit, and a neutral sell. It then sells, and I cash in both sells, so the original one and the new one. Now I still have an open buy. This is where you can understand it becomes kind of like that social media, social trading, high win rate nonsense. Position, sell, obviously I have 0 profit on sell. There's one of a profit of 100, there's one of a loss of 100. Or 0 and 100, basically, right? So they negate each other. I still have the one original or the second buy open that I opened here, so that one's negative, but I cashed in twice along the way. 1 buy and 1 sell cashed in. This sell closed at 0, this sell closed at plus 100, this buy at 100, and this buy is now minus 100. So my profit, all my equity, is 100. Because I am already negating the 100 buy. So I already made $100 profit doing that. You do understand that if it decides to go into a certain direction continuously, you're opening more and more negative trades along the way, and you're literally waiting for the grid to turn direction, which is going to become clear in another technique that's a little bit more adapt to that, but requires a lot more capital, is version 2. So ladder versus martingale. They're similar but different. So a ladder, what you do is you enter a single new position against the trend, each grid of the same lot size, right? So the example again, let's say we go from 0 to 1. I open a trade of a buy at 0 for 1 mini lot, and then at 1 I buy another one for 1 mini lot, etc., etc. But this usually goes from the idea of while it's selling, so more in the direction of a swing trade approach. So you predict which direction the market is going to go. So as the market is selling, and don't worry, after the slide, we're going to go to the chart and I'll show you. We're going to see that you're buying, and buying as the grid goes down. You're getting negative position on negative position on negative position on negative position, and you keep stacking up your losing trades. Obviously, this doesn't work with a stop loss because then you will hit one stop loss while you're opening a new one. That doesn't make any sense. So your capital is your stop loss, which is obviously quite risky when you do really, screw up your timing and you really grab the wrong end of the stick. Then you're just building and building and it's not turning around. What happens then is that as the market then flips on the way back, all those negative trades that you bought along the way are now turning into profitable trades as the market climbs back. And that's the whole concept. Now, the ladder system is that every single entry point is the same lot size. Martingale strategy is that every single other step doubles in lot size. So you can understand how you need a ton of capital to do this, because if you end up with 10 trades, that's quite a lot, right? Imagine doing one mini lot. You have a mini lot trade number 1, the second one is 2, the third one is 4, 8, 16, 32, which means you're already through three standard lots and 2 mini lots, right? Do you understand how this keeps adding up? So if you have a $2,000 account, it's just impossible. There's no way you can pull that kind of capital. You don't have the margin for that kind of down draw, right? So understand that this is pretty heavy. So before we get to Fibonacci, let me put this into a chart and show you what we actually mean. All right, so here we got, let me switch to a year, and this is a bit of a bad day for this, but that's okay. It's actually not, it's a good day to show actually why not. Right, so first of all, bugger off. Let's just zoom out a little bit. All right, so let's say you do your trend lines. Obviously, we have a breakout right now on a downward trend. You have an acceleration. We're not going to get into that today. But what we can do is, okay, let's determine the previous like kind of resistance point. What is this terrible line? Let's make it like that. And anybody, let's do black. I think that's pretty obvious. Boom. I hope everybody can see this. So for those that use this system, then that's fine. And you just determine it this way. Right here we have a little bit of a resistance here. Do we have any wicks? Not really, right? So let's just go with this for the example B. Will you work with me? Sometimes. Right, so here we have one, and now I'm going to judge the previous one based on this again. So we come over here, there's 1, 2, 2, 2, so somewhere over there. So based on this, I roughly estimate that this is going to be the rough distance between different resistance points. So what you can do then is say like, okay, I'll take this average distance and just make it equal, right? And now I'm going to add in the grid. So you literally just divide it up like this, right? So roughly the same. Obviously, you need to take a little bit more time than I'm doing right now. So you take all these ideas, and we'll do it up as well, because we're going to scroll a little bit to the left to see how that historically would look. Turn these two back burgers off. So let's go historically, and you get the idea. So here we're a little bit more historical, and you get this idea, right, where it touches your lines over and over. Right, so that's the concept behind the good trade, and obviously you extrapolate the grid and so on. Here you would just be trading buy, sell, buy, sell, buy, sell. So what happens in this scenario is, let me move this out. I am now expecting that I expect this market to retrace at some point, which would be logical, most likely to something like the point of the upper trend line as a resistance line, something like this, based on that was the first influx. So probably here, right? So you do something like this, and then you would expect it to eventually like bounce into this somehow. Now, this is also the concept of grid trading, except you don't do any of this. You just blindly go on the grid. It's almost like naked chart trading, really. But what you do then is you basically have pending orders, right? So every line that we passed, every single line we passed has been a buy. So here, right? Here I might have still been selling, and now I'm selling. But let's say you decided to buy, because you need to see, if you're obviously selling, like you sell here, you buy here, you sell here again, then sell, 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 sell. But the other aspect is, right, so the buy and sell system, you do have a bunch of sells in profit right now, but you also have a bunch of buys in loss. And every sell you've been cashing in along the way. Every buy that's open from here is still open and open and open and open. So you're waiting for it to go back. The ladder system, however, goes with the idea that I do this. Buy at a mini lot, we said, right? So Every line we're buying at 0.1. Copy that. Hey, copy it. I want it. Just copy it. God damn it. Can't I copy this? Why can't I copy this? All right, fine. Can't copy this. All right, so 0.1. So this is buy number 2, buy number 3, buy number 4. I think that kind of explains itself now. So what happens? So once this market finally changes, and it does go back in this direction, your lowest buy will be the best possible entry point, and you're making profit along the way again. Now you can choose then to close every buy along the grid as a cash out, or decide for yourself a certain take profit level. For instance, I don't know, the first grade above the last buy-in, and then you profit. Then you profit 1, 2, 3, 4 trades in this case. But the fourth one being, this one is only 1 grid. This is 2 grids, 3 grids, and 4 grids. That is the concept of a ladder grid. Right? So you basically anticipate the market will eventually return to previous price levels, which it generally does. If you look at the bigger trend, right? If you do something like this, you can see how many times it's been through it and been through it. So this is on a week, obviously, but on a day, you can do the same thing. You can see how day trading would be affected by this, et cetera, et cetera, et cetera. Hey, work with me. All right. So here on the day trading, you see that it's not even that crazy what we're doing. So we would expect it to go back up and down. And, eventually, if you take the trend line all the way from up there, eventually down here, it will turn back around. And personally, not big of a fan on this whole thing. But for those that do want to have a really easy way and you have the capital for it, yeah, it's definitely something you can implement in the more stable things. Like I mentioned, the dollar CHF, for instance, if something is moving sideways, that is the moment where grid trading shines, because you're trading every single movement possible. Right? Where generally speaking, other techniques, you're judging certain entry points to try and hold for prolonged periods of time, unless we're talking about specific day trading or intraday trading. But generally speaking, you're looking for an entry point to have a trade develop over time and then build out your portfolio with a diversified setup of trades. In this case, you're literally just throwing all that idea out the window and just going like, I'm just going to buy at every line or sell at every line. That's what I'm doing. And I'll just cash in once it passes it again. And you're never closing the position. So obviously you're going to have accounts in massive downdraw. That is why it's not for small accounts. It definitely is a thing that you need a bigger account for. Okay, because you can understand, let's say even if you do a micro lot, if you have 20 trades open of a micro lot and you're 300-400 pips down, right? That's not $30. That's 30 times 20. Well, deducted, but right. So you're building this up. So it's definitely a technique that you could apply with, for instance, swing trading. But swing trading, you would have a different approach to entry, right, based on volume in the market and timing and stuff like that. But this is ladder trading. So Martingale is quite literally, instead of I go in with 1 mini lot there and 1 mini lot here, I would go in with 2 mini lots. And then at this line, we're going to go in with 4 mini lots. Right? And then here we go in with 8 mini lots. And here we go in with 1.6 standard lots. Right? So that is the concept. Somebody points out there seems to be a technique that the bots use. Actually, yeah. There's a lot of trading robots that utilize this system that basically are built on grid trading. No matter, because you don't need a dynamic algorithm to do this. It literally just divides up the market in a certain set difference either in fixed pips or in percentage of price change, and then it runs. Which is also why you understand that most trading robots eventually blow up the account, because they'll grab a trend that is completely shifted in market from a fundamental point of view, and then it just runs the account into the ground because you don't have a stop loss, so it just keeps adding and adding and adding, and eventually, regardless if the positions aren't closed yet, eventually you get margin called, and then the system will close the trades for you. Right? So be careful if you want to decide to go grid trade. Okay. That was the easy one. So let's go to Fibonacci, which is actually simple if you think about it, right? So the reason we use Fibonacci is, like I said, quite simple. Fibonacci is used to calculate retracements. This is why we say Fibonacci retracement. It is, however, not to indicate trend reversal when you're talking about the larger trend. So if you have a weak trend that is roughly, let's say if you have a weak trend based on, I don't know, say oil, it usually holds for a month or 2, 3, usually Q1, Q2, Q3, Q4, it has a certain behavior. Okay, Fibonacci only calculates the retracements in a certain period of time, depending on the time frame you're looking at. It doesn't look at what is the bigger picture doing, right? So it's really just for the pullbacks or rallies, depending which way we're going. Now, one of the things that Fibonacci does require is that it kind of has an established trend, because if you just had a double top and it's creating its first downward trend, you're not quite sure if you're at the bottom of the first wave, the first impulsive wave, which is Elliott Wave. We'll come back to that in a minute. Or if that it's just doing a little knee jerk and then back, right? So it's going to take a little bit of practice, but that's with all these techniques, right? Now, one of the things is that you basically want to buy on pullbacks. So pullbacks are in an uptrend. That's a piece that you go back the other way, right? So down. And you sell on rallies, right? So if you're in a downtrend and it pulls and you have a rally, so it climbs back in price, you want to buy, you want to nip the best price. And that's where the Fibonacci retracement levels come in, because generally speaking, the question, especially from starters, is, but how do you know where it will retrace? How do you even know? Well, apart from your technical drawing, which is going to be your support and resistance levels that it met along the way based on historical data that it might have ignored on the first push down or first push up, you do know that on a retracement, generally it will start adhering to these lines a little bit more. Now, there's a really extremely complicated way to explain this mathematically, but simply said, the average retracement hits lines 38.2%, 50, and 68.2%. That should be 62.8, but that is the retracement levels. And I'll show that in a minute. The extension levels then, so this is for the retracement level. Now, on that retracement level is your judgment for entry, right? So let's say we're in an uptrend and we have a pullback. And if that pullback goes back 38.2%, so only about 40% backwards, then we add, once confirmed by price action, right? Or just a confirmation of a closed candlesticks the opposite direction, that is kind of a conversion that we're done dropping. Not always, obviously, but you then go in with your new trade. I will then tell you how you set your stop loss, because you basically have your retracement levels as resistance points. And then you basically found a better entry point to the existing buy. Or in your case, maybe you hedged it when it started the pullback. You can now close your hedge and add a secondary buy trade to your existing buy trade to amplify your existing trade. Or double up, basically, right? So these are kind of things to, and it also helps judging if you're one of the people that, like me, that manually moves your stop loss to certain levels. Like, it helps you judge which far your trailing stop is going to be if you're not going to be there, or where you're going to put your manual trade, manual stop loss, because you know that the retracement should not be more than 68.2, 62.8. I should retype that, but whatever. Now, when it comes to take profit for those entry points, you extrapolate past the previous high and they correlate with the retracement. If the retracement was 38.2, then generally speaking, the next stop is going to be 138.2. If it was 51.50, if it was 162.8, 162.8. Just ignore the typo there. These two should be the other way around. Now, like I mentioned, price action is your confirmation before you go in. You don't go in on an active candle, ever. This is trading 101. The active candle doesn't count because it can still do whatever it does. You wait for confirmation. You wait for the closure of the active candle. For those that are more advanced and that are a little bit more experienced, might recognize certain pattern buildups and volume within the candle to see whether or not it's pending orders being hit or whatever. But generally speaking, just wait for price confirmation. Now, before we go into the implementation of the chart, there's a thing I want to note, and that is that Fibonacci is technically a self-fulfilling prophecy. The reason I'm saying that is that because so many traders utilize it and correspondingly use it with pending orders and using those levels for pending orders, once the first uptrend, let's say in an uptrend, you get the pullback stops at 38.250 or 62.8 because of the amount of pending order that hits along the way, flipping the volume back around from the original buyers that are now closing their positions. Right, that's the dynamic. So it's because so many people use it, it works the way it works so consistently. That also means that if you find something that doesn't have a lot of volume, I don't know, Houston Satellite Company.co, right, that has 6 employees and a guy called Steve, if the volume in that is $4.50, yeah, obviously it's not going to retrace that much on Fibonacci levels because there's not that much volume or traders creating pressure in that market. I hope that makes sense. So that's where Fibonacci would fall flat. All right, so let's actually go to a chart. Let's see what this looks like. So let's take the same example again. Get rid of all this. All right. And we're doing this on 1 hour. You can do this on a day. You can do it on stock. You can do it on oil. You can do it on Bitcoin. It doesn't really matter. The concept is the same anyway. Okay, so we already said we don't really use an active level, but we can back test it and just see how accurate is this really. So let's take from this area to this area, and we should say this area. We'll back it because this is kind of where it stopped the first time, which would make sense, but we have this happening, right? We have a further breakout. So first of all, you're always trading with the trend, generally speaking, right? We're way too small fries in order to judge that we can make the market shift. First of all, you don't have the capital for it, and you're delusional if you think you are. And second of all, it just creates better consistency with your trades. It's generally what you want to do. Consistency will create profitable accounts in the end, not I will pick whatever by throwing a dart at a board and hope for the best. That's not trading, that's gambling. Okay, so we have a downtrend here in a larger downtrend. So there's definitely pressure, and we can see there's a slight curve of it accelerating, obviously now, but let's say we're over here, we have this initial, and we get this first confirmation that it kind of stopped. So now we want to judge, where's the pullback going to be? Well, the first question is, where do I start? Well, the answer is very simple. You start with a downtrend at the highest point it came from, because that would be 100% return. If it pulls back to the previous high, that is 100% pullback. 100% rally. Apologies. If, however, it goes anywhere between that, you get a different number. So let's grab it. And let's grab it here. If for some reason it doesn't extrapolate properly, that's a bit annoying. So here we have our extrapolation. You can see here it went to 61.8 on the mark. Now, if we would now flip this to see where is the then extrapolation. Oh, come on. There we go. I don't know why it does it like this here. That is a little bit annoying. Because this should now look, this should just pull across the screen. That's what I'm used to, but okay. Right, so now we want to know if we flip it, we get the same number again. Right, we need to make this correct actually. There, let me zoom in a little bit. I hope it's visible for everybody. Let's make this a little bigger. There. So if we do this, we can see now the 100%, right? This is the full. Pulling back to 0 is no, but 38.2. So the corresponding profit number should be, if we use this as an entry, we have a stop underneath it. We have a confirmation afterwards. I have a little pullback, which gives you the confirmation for the third time. So I decided to go in on this candle. Obviously, I didn't do it perfectly because I'm not perfect. I'm scared and I don't want to go in too early. So this is the trade that we're going into. So now the question usually is two things. One, where's my stop loss? And two, where's my take profit? So who can help me out with that one? This is the part where I get interactive because otherwise everybody falls asleep usually. So remember what I said about corresponding levels? Whoops, what do I do? Oh, okay, now we're good. So when your Fibonacci retracement goes back to the 38.2, yeah, so stop loss wise, you go to the previous level, right? So the 38.2 is on the mark. We already have two wicks that we can consider. So you either stop loss right above it, which is risky with the wick. So the ideal stop loss in this scenario would be here. This is outside that wick. So that should confirm your stop loss levels, right? So that's how you would determine that in this scenario. And we'll make that red, right? So we got red. That's our stop loss. That's good. How many percentage is that? We're just calculating. Oh, that's only 15 pips actually. So we're calculating that one. Now, obviously, for those that do technical analysis, this happens to also be the resistance point. But let's say the resistance point is over here. Then you would also be safe because the trend line would be somewhere here. And then the resistance point, so you would still have the rule of outside trend outside of resistance, right? Your double line rule. Now, if it is with it, let's say the resistance is here, then your judgment would be, I will move it just above the resistance because then I know for sure that it can only go there if it actually breaks the fundamental aspect of the trend, right? But okay, that's a bit more advanced. So now the take profit is, and I don't know why it only has the 161.8, because the 150 is somewhere over here. And there you go. Somebody already said it. The TP is at the 138.2 line, which should be somewhere yonder. Not sure why this one doesn't use it, but that's okay. Now, this one happened to go past the 150 and almost all the way to the 161.8. That's okay. You don't have to have the perfect exit and entry. Remember that, right? As good as with as little possible down draw is fine, and the take profit doesn't have to be that perfect point. You just want to make the best possible. And even if you are, let's say you are actively trading daily, what you can do is obviously then just manually move it as the trade develops with a trailing stop behind it for possible like knee-jerk pullbacks or knee-jerk rallies in this case, I should say. Right? This is the concept, right? So if we now extrapolate this idea, we see that here it was a perfect example of 38.2, and then it continued the second. I shouldn't say a second wave yet. Then it continued that. It hit the take profit. Boom. You're done. Easy trade. Even if you went in early, let's say you were too eager and you went in somewhere over here. Sometimes this thing doesn't work with me. Come here. Let's say you were too eager and you went in somewhere over here. As long as your stop loss was out here, you just had it as a down draw and you would still have the same take profit because we're using Fibonacci as a rule. One of our rules, right? Like I said, techniques to improve your strategy. Obviously, your risk management and other exit strategy determination will add to this and give you that diversification between where it's going to be based on your lot size. If you're using fixed lot sizes, variable lot sizes. See, I use variable lot sizes, so I usually draw it up like this. Now I can do one simple thing. All right, now I know what my stop loss size is. Okay, what did we say? We went in here, right, after second confirmation here. So the stop loss is 14 pips. That's really small for my taste, but okay. I generally do day chart, but okay. So it's 14 pips. Let's say I have okay, let's make it realistic for you guys. $1,000 account for the most of you. Don't get this the wrong way. $1,000 account. It's a 15 pip stop loss, and my risk level is 3%. Right, I'm willing to risk 3% of my account on every trade. That is my general, how you call it, risk acceptance. So this 3% that I'm using, okay, now I can just calculate. So 3% of 1,000, 30. This is 15. So okay, that's easy. This is a 2 mini lot trade, 0.2. Okay, and sell. Right, this is the active market, so I can just sell at market, or I can set a pending order and then set up the take profit stop loss. I don't care about the take profit generally because I only care about losing money. The more money I win, the better. I generally never heard people complain about winning money. Now you heard them about the other part. All right, so now let's do this thing again for one more example, the other way around. So we have the same thing here, right? We go up, up. We got our, and sometimes I'm just basically dumb, right? See, I don't like, why does this not extrapolate it? It's so annoying. It should do this. Now, I'm not using any of the chart on the left. I'm literally just using this black line and putting it underneath that. Generally speaking, when you draw Fibonacci like this, it will extrapolate these lines across the screen. But you will see, even if I do it the other way around, it doesn't do that. Which is weird. It shouldn't do that. Because here it says like the percentage, but anyway, let's do that again. So I have to do this first. It's not the end of the world, but it's just, something of use. Right, so now you might say, okay, well, 38.2, here we use wick here, we use wick here. Some people will say, well, it should be that wick. Not really, because this is where it stopped, and then you have the first directional change candle. But both are fine, and both end up with the same number anyway. So in this end, there is some freedom and merit to it. So the rule goes again. We go to 138.2. So 138.2 is here. And in this case, yet again, we went to 161.8, except this time we're actually already past 261.8 because we had a breakout in acceleration of the trend. But again, Fibonacci retracement, which is what we originally cared about, this part, how much of this did it retrace? Again, 40%, 38.2. With the wick, it's probably 40%. Right, so it's pretty accurate. See, normally you would draw it the other way around, and this will extrapolate, and then there should be numbers below this. Can't you see that? Levels. Do I have to add them? Really? I have to add the negative? Okay, well, we're not going to do that, but anyway. I'm used to MT4 for the years, so MT4 used to have both ways. You have extrapolate positive and extrapolation negative. This one doesn't. So in an uptrend, this would be fine. You have the extrapolation there. In a downtrend, you just have to flip it upside down for a second and then think the other way around with the two numbers. Not the end of the world, but there you go. All right, so That in essence is Fibonacci. It's really not much more complicated than that. Now, for those that stuck around, now we get into the more technical stuff. And I'm going to try and complex this because we are running out of time. Obviously, it's quite a lot. This is going to take 15 to 20 minutes on its own. Well, not really, because I prepared everything in this case. So let me explain it. For those that want more in the Q&A, we'll have time to discuss it. All right, so Elliott Wave principle. Now, Elliott Wave was developed by a stock trader called Ralph Nelson Elliott. I wonder where I got the name from. Now, Elliott Wave principle, people say there's 3 repeating waves. Yeah, but that's incorrect. Elliott Wave principle is actually built up out of 8 waves, and we consider them 5 waves. I know. It's wave 1 to 5, and then wave A, B, and C signifying the end of the trend. This will become clear when I go to the example that I prepared. What you need to understand first is there's impulsive and corrective waves. Okay, so impulsive waves are the waves that are in direction of the overall trend, right? And corrective waves are the little pullbacks or rallies that you get in between them, right? So when you're in a downtrend, right, the impulsive wave is the selling period. The corrective wave is the rally, making a V shape. Well, actually more like an inverted tick box. And you do that. Now, every Elliott wave to complete has 3 impulsive waves and 2 corrected waves. Now, they're numbered 1 through 5. Impulsive wave number 1 is wave number 1. But corrective wave number 1 is wave number 2. So 1, 2, 3, 4, 5, 6. 5, sorry. Now, I also mentioned waves are fractal, and this is way too complicated or way too detailed to actually show you now because we literally just don't have the time. But every impulsive wave on a day chart, which is quite an extensive period of time usually, is made up out of 3 impulsive, out of 3 waves. So two impulsive and 1 pullback on an hour. And those are built up out of 2 and 1. And those are built up out of 2 and 1 as lower as you go. So it's like a returning fractal system. Now, people ask about the corrective size. Usually speaking, wave 2, which is corrective wave number 1, is a 60% pullback or rally from the size of wave 1. Where did we see that number before? 61.2 comes to mind. You can pick that one. We literally just discussed it, right? And you'll see that again because wave 3 is generally the longest rally, or the longest, depending on if you're in downtrend or uptrend, it's a rally, or it's just the longest. And that doesn't have to necessarily mean the biggest amount of pips. It means the longest lasting one. So in distance, either in distance or in pips, right? It's the longest lasting. Elliott wave is pretty fluctuant. We'll get back to that later. Now, wave 4, which is corrective wave number 2, is typically 30 to 40% of wave 3, the long one. So if the long one was long and flat, that one's going to be long and flat as well, which is one of the guidelines we'll get to in a bit. Don't worry, we're going to see this on a chart when I've discussed all of this. We're going to go to a chart, and I've plotted one out for you so you get an idea of what it looks like. Now, the Elliott Wave principle has 3 golden rules. This helps you eventually set them up when you're trying to learn how to draw these. And I'm telling you this now, as a beginner, forget about it. This is not something you should focus your time on. At the start, you should focus on learning how to do technical drawings, understanding fundamental announce releases, entry and exit, price action, risk management, like all the basic stuff first. Then you start adding this. This just helps you with better timing and min-maxing your entry and stuff like that. So the 3 golden rules are simple. Rule number 1, wave 3 can never be the shortest wave. It doesn't mean it can be shorter than number 1 or 5, but it can never be the shortest wave. If you find what you think is Elliott wave and wave number 3, which is a second impulsive wave, is shorter than the other two, either in duration or in pips, you misplaced the waves. You need to restart the count. It doesn't always complete 3 waves. And sometimes they change in interval. They can be really short together. They can be really long together. It depends. Okay. Now, wave 3 also has the golden rule that it must end up higher than wave 1. So you cannot have a double top. It must be a new high or a new low. If it is a double top, Elliott wave didn't go through, start again. New count. Rule number 2. The second wave can never go below the start of wave 1. In other words, the first corrective wave, rally or pullback, can never go past the starting point of wave 1. Makes sense, right? Rule number 3. The fourth wave can never, ever overlap with the price of wave 1. Meaning that wherever wave 1 ended, where the first corrective wave started, the fourth wave, which is your second corrective, can never go past that point. If you would draw a horizontal line, which we'll do in a minute, on the end of wave 1, wave 4 can never, ever, ever be below that point. Then it's not a correct Elliott wave. And that means you restart the count or redraw. Okay. Now, apart from the 3 golden rules, there's also 3 guidelines. They're set in stone, but also important to know. You already understand, right? Elliott wave is definitely not a beginner thing. It takes months, if not years, to master. I mean, I've been using it for a while. I still get it wrong half the time. It's really complicated when you get more advanced. So guideline number 1 is that the third wave can never be the shortest wave. We already discussed this. But the high of wave 3 must be higher than wave 1, right? So this is the one that I mentioned. This is one of those overlapping things. Wait, hold on. Why does it say the guidelines the same as the thing? No. Oh, did it change that again? I hate it when it does that. For some reason, it didn't save it correctly. All right. So I'm just going to say, is it double? No, it just didn't save it. Oh, I hate it when it does that. Okay, my apologies for this one. I'm going to read them out because these are the rules. The guidelines, I changed them, but for some reason it doubled it. So the guideline is as following. Now, let me just remember this off of my head. If wave 3 is the longest wave, so if wave 3 is the longest line, it doesn't always have to be, but if it is, then the fifth wave will be approximately equal to the first wave. So if the middle longest wave, right, is the longest one indeed, and you don't know that up front if you are in that wave, but then you can judge the corrective. And if the corrective then corresponds with the 40%, you can then judge that the fifth wave, the last impulsive wave, is going to be roughly the same size in length and duration as the first wave you drew. And this, you can understand, helps you with your planning on your exit. Okay. Second guideline. The structure of corrective wave 1 and 2, so wave 2 and 4, alternate between the two. What I mean by that is that if the corrective wave number 1 is a sharp rally or pullback, most of the time, wave 4, in other words, corrective wave number 2, I know it's confusing the numbers, but the corrective wave number 2 is going to be flat. Like it's going to be more elongated. It's going to take longer to do the same 40%. And the other way around. If the first pullback is very flat, then the second pullback will be much sharper, generally speaking. And the third guideline, that the waves that, and you will see that in a minute, that wave ABC that comes after wave 5, which is that signifies the end of the whole Elliott wave thing, is that they generally end at the end of, no, I need to say that right, wave 4. Wave 4 is the, yeah. So wave 4 is the second corrective wave. So wave C should end at the same level as that one. I know it's confusing. I'm going to show you that. I know the screen and voice not for some reason the guidelines, I saved it twice and it keeps going back to what it says in the rules. I don't know why it's doing that. I'm sorry about that. I'm going to show you in a minute. All right, so limitations. Well, apart from obviously that it's hard to master, clearly. Elliott Wave has a very subjective nature. Now, that means that is also the reason why some of you may heard that it's not adopted that much. All right, so Elliott Wave is not that easy in order to determine the 5 waves and the 3 ABC waves. Right? Even if you have an existing chart and you're back testing it, I can guarantee you at first you're going to struggle finding any Elliott wave, because everything looks like a potential Elliott wave, yet nothing does. It really takes practice and practice and practice and practice to start figuring out how these retraces work with each other. On top of that, Elliott wave is generally not adopted as a trading technique that much by a lot of traders, and not necessarily due to the lack of knowledge on it, but more due to the subjective nature, like I mentioned, right? There's no rule for entry or exit. Now you can already understand, because the retracement levels kind of correspond, well, they correspond with Fibonacci retracement. So the corrective waves correspond with Fibonacci retracement. If you combine it with Fibonacci, you can start plotting it out a little bit into the future much more accurately. Right? Any of these techniques on their own is not enough to do trading. But if you start combining them, and then combine them with technical analysis, and combine them with your indicators, and combine them with fundamentals, combine them with your risk management, entry and exit, etc., 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 then you start getting there. Which for a lot of people, they end up like skipping Elliott wave and just adopting Fibonacci retracement instead, and not really caring about the wave principle that much. Which is usually why the concept is, okay, I'll just trade every retrace in a trend, and that way, eventually when the trend ends, I will lose that trade, but I've won the other ones, because that's the consistent rule. So I'll take one loss for the other 3 winnings. This is the Elliott wave. You're basically trading the 4th wave or the 6th wave that doesn't exist. Wave A, you're trading basically. After you learn all the basics of Elliott wave, then you can start learning to implement it on things like day or swing trading. When you start getting into, after you've understood the basic concept, then you get the more advanced concepts where the mathematical correction behind it and why it does it, and on what stocks it works and what doesn't work, and what financial instruments you can apply it to, et cetera, et cetera. So like you understand, Elliott wave is definitely not beginner friendly, but it is very useful to learn, because it learns you how to identify and plot out. And once you get a hang of that on existing trends, right? So if you go backwards and look at 2018 and start trying to find them, then you can, when you start mastering that, you can extrapolate that information, add, for instance, Fibonacci to it and your indicators, and now you have much better ideas of where pullbacks and rallies are going to go, how far the take profits into the future are going to go, instead of extrapolating a trend line to judge roughly where it's going to hit the next resistance. Like, this is just a more accurate version of doing that. And then you, generally speaking, only trade in the direction of the impulsive waves, and use the corrective wave to judge new entry points, basically on the average retrace levels, right? So basically Fibonacci, And then you use Fibonacci extrapolation in order to judge where's my take profit going to be, because that's probably the end of the next impulsive phase. Right? So they go hand in hand because they do a lot of the same things. Okay, so let me just show you what an Elliott wave would actually look like. This is on an hourly chart. You can do it on an hour, day, week, doesn't matter. All right, so here we have the impulsive waves. That's wave number 1, 3, and 5. And here we have the corrective waves, waves number 2 and wave number 4. And here's the rules, right? Rule number 1, wave 3 can never be the shortest. Okay, it isn't, because this is definitely the longest period. These were all sharp down. So this is definitely the longest period that it's held. You can count the candles if you want to make it easy. Second of all, wave number 2, or corrective wave number 1, flat. Wave number 2, sharp. Confirmation again, right? That was the 2 rules, guidelines. Second of all, and now you see that because number 3 was the longest, if I double click wave number 5 and put it over wave number 1, they're roughly the same size. This one is maybe 10% more. Unless you do this and you factor in this whole thing, which you shouldn't do with Elliott wave, but even then, it still holds as an Elliott wave. Now they're exactly the same size. Okay. But in this case, the retrace, basically, you can take the golden middle step somewhere like here, that technically, like, this is where the retrace started. But Elliott wave 1. And this is wave A, B, and C. And you can see C hasn't completed yet. So I extrapolated it for you. This should be down here, but it doesn't really matter. Because here you can see that the extrapolation is based on this level. It should end up somewhere over there, which is the previously plotted wave 4. Zigzag indicator doesn't show the wave. Elliott wave really is a principle on its own. It's definitely going to take you practice to do this. I mean, I can randomly grab a chart and, start planning it, but even then, like, you could say, like, okay, so let's take a look here. I would say, like, okay, so this is maybe impulsive phase number 1, pullback sharp. Impulsive phase number 2, that's pretty short. Pullback number, oh, no, wait, no, rule doesn't apply. Wave number 4 goes into the price range of wave number 1. So this can't be the Elliott wave. So we got to restart the count. So now you restart the count here. Wave 1, pullback 2. Okay, that's about 60%. That makes sense. Definitely the longest lasting. Well, almost. Wait, hold on. This one should be here. Okay, so they're about the same length. Definitely not the shortest. Then we get, nope. Again, pullback is all the way into 1. So this is also not the Elliott wave. Right? So it'll take a lot of practice to do this. Now we're doing this on a week, which is what you shouldn't do. But right, so even if you do it on a day, you can understand this is going to take a lot of practice to start identifying the actual pullbacks and rallies and stuff like that. Right, so here you can judge this one into that one, but then you got in wave 1. So here it only did a 2-wave system. Here it only did 1 wave because it didn't actually rally. Then you can go like, well, I can also zoom out and say wave 1 pullback, wave 1 pullback, wave 2 pullback. Yeah, but now you're, what is this, wave 12? Right, so it as much as you see the zigzag, it doesn't mean you can judge the entry and exit for Elliott wave. It's going to take a lot of plotting, a lot of practice, and a lot of try this, try that until you find it, and then you know which wave you're on. Once you know which wave you're on, you can start using the previous data and how they usually build up based on the rules and guidelines to then extrapolate the idea of how it's going to develop next, and you correlate that with technical analysis, indicators, fundamentals, price action, etc. All right, so I know this is a lot. And for beginners, definitely probably just something I like went straight over my head. But it is good to understand how these things are out there, that once you've mastered the basic starting points, so technicals, fundamentals, risk management, how to do calculation of lot sizes, stuff like that. Once you have that nailed down and learn how to judge your entry points based on that, you now add this, and now your entry points become better because your timing becomes better, and you start fine tuning things. Now, for those that are on the recording or YouTube, thank you all for listening, and I wish you the best of luck with trades, and I hope this helped. I hope to see you on the next one.